Hi everyone, second video for tonight's lesson. I'm going to discuss record keeping, and it's going to be simple tonight, and we'll get onto it in more depth on Monday night, okay? And I'll probably recap on it as well. Okay, so as a business, you engage in various activities whereby money flows through your business. So money flowing in and out of your business, yeah? So cash in, cash out. What's better? I think we all know that. It's cash in, yeah? So you want more money coming in than coming out. And they're known as transactions, okay? So transaction would be like buying materials and you get a purchase order and a tax invoice for certain items that you need to pay for, okay? So cash in, as we probably all will guess, is money flowing into your business. It may be income from completing a project, selling assets within the company. Contributions could be contributions from directors, or could be donations, which is highly unlikely in construction. And then loans, getting loans for your company. Okay? Cash out, so money flowing out of your business may include expenses of carrying on the business, so that's cost for materials, um, uh, workers, wages, items like that. Payment to buy or replace business assets. Payments to you from the business, so they're drawings, as I said before, with regards to staff, or drawings for yourself. And then obviously money lent to others. Alright, the following diagram shows how money flows through a business. So money in, it's pretty much as discussed before. Completed works income, asset sales, owner contributions and finance, which is lending. Money out, business expenses, assets purchased, owner drawings and loans by the business. Transactions. In order to protect all parties, these transactions are supported by documents recording their details. Okay, so there's no more the old-fashioned handshake or she'll be right, mate. Now, there are different types of transaction documents or source documents, which are they're better known as, and they include your tax invoices, wage records, check butts, credit card statements or your bank statements. Okay, and there's others. They contain information you need to record, such as the date of transaction, total payment or amount received, amount of GST, and there is an example there. Okay, so just for a purchase order, the total amount of materials and a total at the price at the end. Okay, so the most important reason for keeping good records is that it's a legal requirement. By law, you must keep business records for 5 years after they are prepared, obtained, or the transactions are completed, and in English form, okay, that they can access, the ATO can access and understand. So, what would you use? Electronic or manual? You can use just a typical stock standard exercise book. You could go to Officeworks or newsagent and get a commercial cash book, or you could just get something online. Could possibly be a spreadsheet or some fancy app. That's up to you. Keeping records include items like your motor vehicle expenses. So most people use their vehicles in their business, so how you claim motor vehicle expenses differs significantly depending on whether you operate your business as a company, a trust, sole trader or partner. And we have well, that's a pretty ordinary example of a car logbook. Okay, so just filling in those details and keeping records of the kilometres taken. Alright. A basic record keeping system is structured like this. So you need to record your transactions, and then you've got to put them into your cash book. Now there's two parts to a cash book. You have a cash payments journal or a cash payments book, which is money paid, obviously, and then you have a cash receipts book or cash receipts journal, which is cash received. Just going down, you use this information from your cash book to complete your activity statements and annual tax returns, and you also get a bank statement. But what we do is we try and reconcile that and ensure that there's no money missing. Okay. You can also use this information from your cash books to manage your cash flow and your forecast, your future cash flow. Okay, they're generally in two parts, as I just mentioned. So you have your cash payments section, which is for money going out of your business, and your receipts, or cash receipts is money coming in, so money received. So you would prefer money in rather than going out. Cash payments is amounts of money you pay for goods and services you buy for the day-to-day running of your business. Cash receipts book. A cash receipt book is a list of all the income you've received for your business. So as a builder or carpenter, for example, that'd be for completions of jobs or work done per week. Once you've completed a cash book, they can be incomplete as you compare to your bank statement. They may have put extra transactions through your account, such as your bank fees or your interest charges, or direct debits from payments and direct credits from receipts. So you just got to check that and just reconcile it, and we're going to do that next week. So doing a regular bank reconciliation will allow you to take into account any extra transactions that your bank puts in through your account and check and record any errors or omissions. So it's just finalizing, just making sure it's fine. Simple flow chart shows us how we work it out, as I showed before. So you record your transactions into your cash books, receipts or payments, and then you do a bank reconciliation as per your statement. I hope that helps. Thanks everyone.